Many people feel deeply uncertain by the numerous crises and risks that seem to emerge. When I joined the ESM, a close relative actually asked me, Rolf, is the euro safe? And at that stage, my honest answer was, we are working on it. If that same person would ask me that question today, I would answer, yes, the euro is safe, but there are few improvements we need to work on. That is exactly what I want to discuss with my guests today. We will talk about the sources and types of crisis, the lessons from past crises, the improvements achieved, and what is still to be done. And for that, I have two wonderful guests. First, it's John Cochrane, a leading US academic, senior fellow of the Hoover Institution, and he has written a great book, The Crisis Cycle. And then I also have Natacha Valla as a guest. Natacha worked as a senior official in the ECB, so she has an inside view, and now she is dean of the 𝗀𝗵𝗿𝗀𝗀 School for Management and Innovation. So she looks at new trends. Let's call the guests in. Welcome to the ESM Lunch Talk. John, Natacha, great to have you here and to discuss with you. We will talk about crisis preparedness, the challenges for governments and central banks. Me working in a crisis resolution mechanism, I have a view obviously on where we see most risks currently, but I really want to toss it to you. If you think about today's situation, what is it where, and you think in Europe, what is where you would see the biggest risk for disruption?
Well, in Europe, if I may start, and then we'll bounce back, I guess, but in Europe, as in many other places in the world, there's a stock of debt, I mean public debt and also private debt that is massive in terms of stock, but also in terms of flow, refinancing flows that are coming up for the next couple of years. I think in 2 years' time, we'll have to refinance about 40%. You know the numbers better than I do. So that would mean some potential strains on markets where at the same time, central banks and the ECB, for that instance, is withdrawing from debt markets, at least is reducing its stock of debt. So it's in terms of flows in sovereign debt markets, we will potentially have some tensions and we'll have to be prepared for that in an environment where rates are higher than in the past decades.
For me, actually, if I may say, but maybe first you, John.
Well, I'm always interested to listen. I think a big point is that you never know what the next crisis is going to be. By definition, a crisis is something that no one expects, because if you knew it was going to happen, first you would do something about it, and people would sell today and you'd have a crisis right away. Now, of course, you want to be robust to the many things that could happen. You want to see weaknesses if you can, but you want to create a system that is robust to the inevitable crisis, as opposed to think that people like us will see it coming and stop it. So let's tee them up. Government debt is obviously a problem around the world. What does a crisis happen when there's a lot of money that can't be repaid, shady accounting, and nobody knows really where everything is? That's government debt. And nobody ever expects it to come. That's government debt.
But that is a point where what I was thinking when you said this about, obviously there is a lot of refinancing need. That's true. For me, the question is this a vulnerability, or is it basically the trigger point, right, of a crisis? And in my mind, if I think about current risk, the biggest risk I see is that we have a political accident, which can be a geopolitical accident, aggression. So a calculated action that actually goes wrong and exposes some security issue. And then markets flip. And that is, so when you talk about the rollover of debt, is it rather vulnerability, or do you see the strains coming that this is going to go wrong?
Right.
I would rather be on vulnerability
side. But this brings us to a key point, I think, in debt markets, but in markets in general, is that usually liquidity is an issue, and liquidity is a trigger point, irrespective, almost, not completely irrespective of the solvency issue. And this liquidity issue that may arise for some countries in Europe, we should keep it in mind. And indeed, the political environment that we have in some of the big countries means that those kind of triggers may, lead us to a tender that doesn't happen the way it is meant to happen, or, the counterparts that usually don't come in the same way. And in that case, we need to have purely crisis management mechanisms that are geared towards addressing liquidity issues, so as to sort of avoid making a link to the underlying solvency.
You invited us to disagree, so the other side of this is the fundamentals. Every crisis needs a spark, which is, I think, what you're saying. And we sort of said, here's the tinder, here's the gasoline in the basement, then you're saying, well, where's the spark? And you need the spark and the fuse, which is lack of liquidity. But the problem is not just debt. The problem is debt without the ability to repay it. If we had a big debt and we were all growing well and running primary surpluses in good times, no problem. Everybody would know we could repay it. But I think the danger comes not just the 𝗵𝗿𝗀𝗀𝗀𝗀𝗀s wake up, but say a geopolitical spark. Say, you can imagine any sorts of bad things can happen. And then there's a financial crisis, there's a recession, our governments want to borrow lots more money. And now is when markets say, we're not lending you lots more money. Look what happened last time. And so we are fragile to that kind of spark.
And indeed, if I may bounce back on this fragility comes from current developments, future developments, but also past development, the way we have spent the money that was, borrowed with systematic deficits, right? If that money had been borrowed for, growth enhancing purposes, for productive activities, then we would be on safer grounds because potential growth would be higher, which in fact is not necessarily the case. That's one point. But then the other side of it is that the future investments that we will need to finance, that will be financed by the public sphere most likely, or at least for a big chunk, namely, climate, defense, we still need to document whether this is really going to be growth enhancing.
Yeah, I agree, but that's pretty much, so that's very much in the long term. And it's a long-term thing that we need to have. And yes, if we don't have, we need growth for financial stability. I mean, my concern and most people's concern is more immediate. We don't, not even the next 20 years, right? So what are the risks over the next 2 years? And frankly speaking, at this stage, do I see an immediate debt crisis emerging, similar to what happened to Greece in the early days of monetary union over the next 2 years? No. Where is the risk, right? So what we saw, for example, with Europe, when Russia started the war against Ukraine, was a deep terms of trade shock. You have disruption. Isn't it more this kind of also big disruption that is nowadays a risk, rather than just kind of the what we in Europe would say, or the start at the early days, the more classical balance of payment crisis? You have building up of this equilibrium, so you lose competitiveness. That was the story of the early days. But nowadays, I think the nature maybe has changed.
Well, maybe. So this brings us a bit further away from the pure debt situation. I think the macro environment is becoming more, volatile in a different way. And inflation dynamics, but I would love to hear what you have to say, would probably have more inertia for many reasons. And this means those are unsettling factors for bond markets and for investors, right? So this may trigger, even though those are, macro fundamental terms, those may trigger market phenomena that would then lead to, beyond vulnerability, lead to crisis situations.
Yeah, there's plenty of other places that could cause us trouble, not just government debt. And again, government debt is a reaction to other shocks. Yeah, stock market's awfully high. Are all these hundreds of billions of dollars being poured into AI centers going to really pay off quite to the extent to which people think, or is another 1999 on its way? That's just one of many that could happen. So there's plenty other sources of trouble that could manifest itself.
No, indeed. So that was one thing, but there are changes in the environment, in the financial environment, that should be taken into account right now, because they were not there when we built all the system for resilience of our economies. One of them is the increasing role played by non-banks in financial intermediation, and this also links into the exposure of retail investors in the end towards financial risk. And I think this is a new thing where regulation is shaping up, but we need to be aware that something may happen of that nature that would hit directly the citizen.
But I think this is a good and great thing. Our financial system has been astonishingly too fragile. Lots of risks are funneled through banks into short-term debt, which causes a run. In Europe, a lot of government debt is held by the banks in that country and then funneled into deposits. So if the government defaults, the banks go under and you have a financial crisis. So the old financial system drastically needed reform so that risks could be held in the end by long-term investors who get a nice rate of return in return for holding risks that they can bear. You know, when stocks go down, it's not a crisis. Why? Because when the stock goes down, there's nothing you can do but go home, have a drink, and be mean to the dog. When a bank loses money, people go run and get their money out. And we have a needlessly fragile financial system, counting on central banks and governments to always come in and bail everybody out in bad times. Well, that may not be there next time. That may not be there next time. So a retail-focused financial system that is getting outside of banks puts things into diversified money market funds or mutual funds held by pension funds, retail investors. Yes, they will experience losses, but losses are not a crisis. We need to get out of the mentality that anybody ever losing money is a crisis. No, a crisis is a run.
Right.
And with that, we can stop.
Yeah, I agree with that. But if I may add two things. One, on the banking side of the argument, I think in Europe, there's one break missing. Sorry, we're at the ESM.
But maybe before we go to the break missing, I want to make the point, actually, we moved a lot on the banking side. So if we think back over what happened over the past years, not every stock market correction, even if 20% in terms of stock prices caused a crisis. That in line with what you said. Second, if you look from a European perspective and we think back to 23, which was in the US really also a banking problem, in Europe we weathered this pretty well. And I think that is for me one of the parts of the lessons of the past and where actually Europe acted a lot. I mean, we have this banking union. I think if my view of this, that the euro area is now much safer than it was like 1.5 decades ago, has also to do with the fact that we drastically revamped the banking sector and the banks are now way better capitalized. Supervision seems to work better. So I think there we have actually built a safety valve, which is not to say that nothing can happen. And when we talk about, for example, scenario of warfare, kind of seizing of assets or so, there's risk. We talk about liquidity. There's still the non-bank financial sector, but on the banking side, frankly speaking, John, I think we did a lot. I mean, in the US, but certainly in Europe. So on that side, I feel much, much safer.
You did a lot, but there's a long way to go, right? It is still true that most national banks are nationally regulated, are counting on lender of last resort from the same government that is issuing them debt that might go under. So the banks are holding national debt. It's still hard for pan-European banks to exist, which would be able to, if a Greek bank goes under, well, if it's a branch of a German bank, it's not really a problem. But if it's a Greek bank that is fundamentally hoping for recapitalization from a Greek government that might be the source of its problems. So I think you're making good steps. I'm just not clear that we are in a resilient Europe-wide banking system that can survive that kind of.
In a sense, I mean, the weakness is the strength, right? We know that there's this single resolution fund, which is meant to be, and the ESM is heavily involved in this, meant to be the last bit missing. And once we have it, I really trust we will have it if and when we have some, shadow or sign of pressure on the banking system. Once we have it, we will be really on safer grounds for the banking system, which I agree with Rolf, is a lot safer than ever before.
But I think you're safer still if you don't need a resolution. So it's lovely to have it, break glass in case of emergency, but the probability of emergency is still too high.
And then it brings us to your argument before, and I'd like to complement it, because indeed we have this issue in Europe that we produce a lot of savings, right? And those savings are held partly by banks, but also partly by insurance companies, pension funds in some countries. And those savings, for bad reasons, because the regulation is not fine-tuned to the needs of the financing of the European economy today, this money is not spent in the right way. And there I completely agree with you. If we had a framework that would allow those entities to, I wouldn't say take more risk, but really take a long-term perspective on their asset management policy, then that would be helpful for the European economy at the end for growth purposes.
Absolutely. Again, but also on that, it's helpful for growth, and we are very much in favor of channeling savings into productive investment, but there is also no free lunch. I mean, it doesn't work without risks. May I turn to one point which is currently super big in the debate, which is the question of stablecoins. as a new issue emerging on that landscape, with possibly the non-bank financial sector being involved and risks. At the same time, I think the US embarks on it because they think it will be very productive and will help the system. How do you look at yourself in that regard?
I would say three short things on this. First of all, I love technological progress in payment systems and in those dimensions of, intermediation or disintermediation. This being said, I think stablecoins as they are expressed right now, and as they appear in the genius framework in the US thinking, is seen from Europe, it looks a bit like crypto mercantilism. It's a cheap way to get demand for US, fixed income assets issued by the government. We shouldn't be naive about that. Also a way to push US tech firms globally. So this has an impact for the role of the dollar as an international currency. It goes perhaps beyond this discussion. Then the second aspect, which is, I think, really key, it's still small enough that it's not systemic, but it's really the link between crypto assets and stable coins are the safest version of it, and retail investors who are more and more exposed to items, to financial instruments for which they don't necessarily realize what kind of riskiness they are exposed to. This is still a small
So you
scale.
mainly see it as a dangerous thing?
I think it should be looked at very closely to avoid issues with retail investors, which is what we want to avoid.
No, so great, we get to disagree a little. Now there is sort of outright fraud, but short of that, which it should be fairly easy to see that a stablecoin is backed by the securities it says it's backed by. If that is the case, so a stablecoin is a little bit of new technology on very old financial idea. It's just a money market fund that holds short-term government securities. It's a narrow bank. So part of why it's used, partly it does have some technological advantages. Partly what it does is it gets around a whole bunch of regulation. And our central banks, which are trying desperately to stop narrow banks from emerging, even though narrow banks cannot fail and would end financial crises forever, but they threaten competition to the big banks who love to have deposits and do other things with them.
That's in the US that you're talking about.
Well, it's in Europe as well. The competition between the US and Europe stablecoins, the US stablecoin is unfortunately hobbled by not being able to pay interest.
Why is that? This is a robbery of a retail investor, isn't it? The fact that interest rates that are yielded by the assets that are backing the stablecoin are not paid back to the holder of the stablecoin.
Well, robbery by congressional fiat. The law said that the regulation in the US is not going to allow the payment of interest. So getting around regulations is often good and sometimes bad. And the question here, a lot of what stablecoins do is get around regulations, many of which are terrible, like the prohibition on narrow banks, which would have been a wonderful thing, but the stablecoins are getting around it. Now, if Europe wants to take over the stablecoin business, which I heartily approve of competition, start by allowing them to pay interest on the stablecoins as you get interest on a money market fund. Or how about allowing money market funds to offer transaction services? There's nothing magic about the crypto aspect of a stablecoin, that you invest money, it goes into government securities, and it can offer payment services, except you're not legally allowed to do that.
But beyond the technology, as you said yourself, I don't see the huge step forward relative to a money market fund.
I think, again, in terms of risks, well, the risks and benefit trade-off, my understanding is it's mainly designed, and that is also why you are not supposed to get interest, because it's meant to be a means of transaction. That is so basically that flows, whether rightly or wrongly, but as I think at least the intention.
Well, wait, let's hold on a minute. It's meant to be a means of transaction. Interest-paying reserves. The ECB pays reserves to banks on reserves. The US pays interest to banks on reserves. Those are the fundamental means of transaction.
But do you believe
it's a wonderful invention to have means of transaction that pay interest. That, I think, is just a smokescreen for we don't want them paying interest so that the banks can still pay interest and get some money.
I mean, the way where we come from, or what the question is in terms element in the discussion. And on the European side, it's perceived as a source of risk. In terms of monetary sovereignty, as you said, as a source of risk and potential outflow in a crisis situation, and something where we may need to look at our regulation. And the question is also about US dollar dominance, and the US dollar denominated stablecoins are at this stage dominating in the market. So the question is, do you want to have a European counterweight? But what I want to get to is basically, I mean, it's a new source of risk. It comes on top of what you said about liquidity, about other sources of risk that we had. I mean, the question is, if we look back at the past, and as you do in your book, if we look at the current situation, what is the lesson learned? What are the instruments that we have? Do we need to create new instruments? So maybe I mean, we had some kind of old, so to speak, quote unquote, or if we want more traditional sources of risk, which is related to sovereign debt, debt sustainability. Here's our new sources of risk. Do you think that in the current situation, say the ECB has the toolbox to fix them? Do we need different tools? Or the Fed has the
fix
toolbox?
The risk of stablecoins?
I mean, which is the question, for example, do we need to, in an era where liquidity issue may be more important than in the past because of market dynamics, does the central bank have to have more liquidity instruments available in order to support market? For example, liquidity lines to non-bank financial institutions. Nowadays more important than it was in the past. Is this something that we need to take care of also with a view to stablecoins, or will it be mainly a regulatory issue? How do you look at it?
One dimension that is analogous to what we had before, but in a new environment, is that we need a lender of last resort, generally, for all classes of assets where liquidity might be an issue. Now, the lender of last resort notion for central banks has been traditionally meant for money markets counterparts, namely banks. And I think this notion of lender of last resort needs to be clarified for all kinds of assets, including crypto assets and including non-bank financial intermediaries or financial intermediaries that are not counterparts to the monetary policy maker. I think this needs to be thought in advance so as to be able to react as and when needed if a big insurance company is in trouble or a pocket of retail investors gets stuck with assets that don't behave the way they were expecting to. So I think this thinking is necessary. And the second dimension I would add to that question is that given the history we've gone through over the past 15 years, the monetary fiscal nexus needs to really be clarified, right? In Europe, we did a lot of things which we called unorthodox, which for old economists like us were unthinkable when the euro was created in terms of interaction between the central bank and intrusion of the central bank in bond markets. We did it once for good reasons. We did it for a long time, but I'm not sure we would be able to do it in the same way now, given hindsight and given ratchet effects.
So I'm going to be the American in the room. So you're thinking about it exactly wrong. That when something new comes along, which is when you look at it, a dramatic reduction in risk, to say, oh, this is a risk that must be regulated. And second, that we must have the central bank always ready to bail everybody out and inject liquidity so that nobody ever loses money anywhere. Exactly the opposite. Stable coins and their like narrow banks promise a great reduction in risk. And we need to get everybody out of the habit of any time something might lose a centime of value that we're going to come get bailed out with liquidity from the central bank. You need systems, for example, that I can sell it at a lower price. Liquidity doesn't mean I always get the price. We're confusing with I might lose some money with I can't sell it quickly. We need to get financial institutions out of the idea that if I can't sell it in 5 minutes, this is a terrible crisis, central bank, come help me. I need to be able to take mark to market. If I'm having illiquid assets and making good returns on them, I need to be able to withstand mark-to-market losses. That we are going to run out of the ability of central banks to come in and throw money at every problem in every crisis.
No, what is so? And don't understand me wrong. I'm not. No, but to be very clear, I'm not saying that we need to overregulate. I think the European question is, at this stage, very precisely with a view to stablecoins. We actually have a good regulation. MiCA that regulates that area. And the question is it safe enough in the current environment also given development somewhere else? And the fear is not that some people may lose money, but exactly that you may have a drain on bank liquidity and that may cause problems for the stability of the system.
The argument that was made by the Fed to stop narrow banks from emerging. That in a crisis, this would offer a place where people would take their money out of X and put it in. But when was the last time in a crisis the central bank said, no, you must sit on something bad. We're not going to let you get out. They do exactly the opposite. And you've always had the ability to get out and buy treasury debt directly. So doing it indirectly through a new mutual fund is no.
Would you object that nowadays the question of not traditional fiscal dominance, but of financial dominance exists? What is with the UK gilt crisis that we saw? Was it correct to just stop the roller coaster and say, look, you get your things in order? I mean, I know that the US banking crisis 23, one of the points for very specific reasons that emerged was the liquidity outflow, which was much more drastic than what we had seen in the past, and per se causes a risk. So there is a point about liquidity and rapid liquidity movements. That is, I think, the key point that I was making.
Yeah, way too much of the financial system is on the idea we're going to make money, and if we start to lose money, don't worry, we'll sell quickly. That's a fallacy we all understand, except now if we can't sell quickly, the central bank comes in. And financial dominance is very important, and this is, I think, what we need to get out of. So let's to understand the concept. Right now, central banks are worried that if they raise interest rates, all the too big to fail everything that is bet on high interest rates is going to go under. So, if we raise interest rates, we make interest costs on the debt high, and we threaten a big financial fallout. Ooh, we can't raise interest rates. Here comes inflation. This is a big fear. Well, we saw, for example, in Silicon Valley Bank in the US, just an amazing demonstration of central banks' inability to watch risks. Here was a bank that simply had invested uninsured deposits, invested in long-term treasuries, no collateralized debt obligations, nothing fancy. The Fed was unable to see it happening. Interest rates went up, and there was a run on the bank. So that's the simplest financial dominance in the world in a bank. The Fed's entire regulatory apparatus unable to see it. So that tells you we have a real problem with that. We have a fragile financial system that central banks are afraid to raise interest rates because then they'll have to bail everybody out. We need to get away from we're bailing everybody out in times of trouble.
Yeah, okay. I think many people what I have heard would argue it was rather supervisory than regulatory failure, but never mind.
Thank you. No, that's an important correction. Well, it was both. There wasn't, in the 100,000 rules, there wasn't exactly a rule that said you can't have big uninsured deposits and a positive duration. So it was and they said, well, it's a regulatory failure. We need another 100,000 rules. But it was also supervisory, that the people watching it weren't able to do anything.
I think actually with what Natacha said, she kind of brought it closer also what you do in the book. And my question to you, so if you think about today's crisis and you try to draw the lessons from the past, so do you see any need for adjusting, updating, thinking differently about today's situation? Or basically, if we go back and try to learn from what we saw in past crises, we are still fully equipped to handle today's situation?
I think it's not about tools to handle it. We're not in a crisis right now, I hope. Let's hope we don't know what's going on. You never know what's going on in the world outside of us. It is the time between crises when you mop up the moral hazard. And that's our point in the book, and I think that's the central point that I'm trying to make. It's not about, do central banks have enough money to throw at it next time somebody loses money, cries liquidity, systemic contagion, and I need money. Central banks can still do that. We'll see how long. In COVID, our governments threw, in the US, $5 trillion, I don't know how many euros at it, we got inflation. So we kind of found the limits of the throw money at it solution. What needs to happen is cure the moral hazard, set the system up so that not everybody requires liquidity support, bailouts, whatever you want to call it.
In a way, and that's another way of expressing the same idea, I guess, but I think incentive compatibility constraints between central banks and governments need to be rethought, given the fact that we have now tools that are very much well designed. If you take the ECB's on paper, the ECB's OMT program, you have central bank money, but you put some conditionality barriers to access it. Now, given the fact that it has not been activated yet, and also given the fact that there's still a lot of stigma attached to the precautionary systems that you could put before coming to the point where OMT is activated, we are in a blurred sort of situation where we don't know what would happen, and we don't know whether the incentive compatibility constraints that are built in this OMT would be effective or
this
not.
is fantastic.
And very clearly, for big countries in Europe that are perhaps a bit too big for the ESM balance sheet, if there were to be a direct need for intervention.
It's good for me, what you said about let's differentiate between the crisis situation and what we can do in a crisis, and what you said basically I think is the answer, part of the answer of what the crisis toolbox that we have built up on the central bank side and with the ESM. And the other part is what happens in between crises, what happens in the quiet times. And then your argument is, well, the incentives in Europe and elsewhere are kind of screwed if the central bank always steps in and bails out the government and everyone else. And that is why we don't do the cleanup. So the problem is in between. And the other problem is what we do when we are there. So I think it's good to keep that. And maybe on your point, so which is a question then truly of monetary fiscal interaction in normal times, basically. And do we see the adjustment in normal times that we would expect? And that we should expect, that we would wish for?
For monetary fiscal, the adjustment is, of course, we are not in a crisis. So we need budgets that have small primary surpluses to pay down debts. Not happening. And this is a 20, 30 years. I want to go back to what you said, though, because you meant it is rare for me to be at an institution that I think should be bigger and more powerful, and that's the ESM. I'm generally arguing on the other thing. And you mentioned the OMT. So this is the program where you can give a country temporary help with conditionality. And it's something that we advocate for more of in the book here. But then you said, well, do we have the tools? Frankly, the transmission protection instrument is the tool du jour, and that is unrestricted, and OMT is on the back shelf gathering dust because nobody wants the conditionality. So it's a great example of the paradox. We have a tool that would address some of the moral hazards. We have a more powerful tool, which is we can just throw money at anything we want to. That more powerful tool is in force, so you have greater tools, but worse moral hazard.
Yeah. But that's why, exactly, but we can work on addressing this moral hazard, right? To find a mechanism that doesn't make it too costly, to sort of tie your hands. It's like the old central banker thing, but on the side of government. You tie your hand, by having, if you could have a stamp from the ESM saying, ex ante stamp, saying, okay, if I behave today and I'm able to generate a primary surplus, then, I don't know, I get access to, I do have virtually access to the PCCL, but access to something which is like a lifeline that would, guarantee that my good behavior fiscally is recognized in lower risk.
So we've never faced the fact that sovereigns can default. So sovereign risk is still completely treated as risk-free on bank balance sheets, for example.
At the ESM and the EFSF, we had to do with the Greek debt crisis. So I have gone through a default of a country with that institution and a deep debt restructuring. That has happened. So has happened. Was a big fear at the time, big fear because it hadn't happened for a long time, that an industrialized advanced country is actually defaulted. Was big fear on the side of the central bank as well, how this would ripple markets and of everyone else. We have learned a great lesson with it, that you can do it. And we have also learned that what you better don't do with it. So I think it wasn't perfect because we also didn't have the perfect institutions. It lasted too long until we got there. And that implied some losses for people that otherwise wouldn't have happened. So I think there is something to be learned, but eventually it was done. And I still think that the way it was done and the way we have now actually enshrined it into our framework is a valid one. By working on bond documentation and by really trying to make some form of debt restructuring possible and manageable, it will never be a smooth process and it will never be an easy process. No doubt about that. And that is why I have big concerns about any kind of automatism in that regard. But, okay, so I think we have had it, and it's not, and there's really where Europe learned a lesson, that is also a very valid one. I remember the day when actually we had credit default swaps becoming due. And everyone was spooked by what will happen now, and nothing happened. So it's also good to see how some of those mechanisms work actually out, and that you can also calm down to some extent. On the OMT, on the TPI tools, the toolbox that the ECB set up on our toolbox, there are different conditions. OMT is linked to our precautionary credit line. The monetary protection instrument has some eligibility criteria, which are also very close to our instrument. It is also true that we as other institutions have to provide some input to the decision making, which is the sustainability analysis. That sustainability analysis, which is said, will be requested. So I think that there are some safeguards in that tool that also at least want to make sure that there is a kind of a founded decision, but the decision, as you said, is ultimately with the central bank. That is correct.
So there are limits, and it's important to say this. And in fact, I talked with 𝗵𝗿𝗀𝗀𝗃, who says, no, John, the TPI has all sorts of limits on it. But do you think that really is something that markets and governments believe? Because every time the ECB wants to lend money and there's some limits on the old program, they come up with a new program that has different limits and money gets lent. Is it actually reasonable that Italian or French spreads could rise and this won't be declared some sort? We'll find a way to call it dysfunction or whatever. And if that doesn't work and there's some limits, we'll create a new program. I mean, there's still enough letters in the alphabet to make, put four of them together and call it a new instrument. I think pretty much everyone in Europe expects that the ECB will come in and do whatever it takes, including come up with new things that abrogate the rules, and not activate the rather difficult part of the ESM.
I cannot project the future in that regard. What I can say at this stage, and how I look at it from our perspective, so the way that this transmission protection instrument is presented, it's certainly a temporary instrument that is meant for market dynamics. However it will be applied, it can be a bridge to something else if it turns out to be more fundamental. So I don't know how it will play out. What I can say is that on our side, we are prepared to play our part. That's point number one, so to prepare our analysis. And that by itself may also have some power if what institutions may be saying in that situation. The other point is, but also what I want to make is that we on our side are thinking, and that brings us a bit to this question, do we face new challenges? And from our perspective, I do think that we face new challenges compared to the past. And we try to draw the lessons from that, which is also why we have made a proposal to somewhat adjust or look at our precautionary toolbox and gear it to the needs. For example, for the pandemic crisis, we came up with pandemic crisis support that did not have the traditional macro conditionality because that was not needed at that stage. And that, I think, is also a question that we need to reflect upon, what it is that may be more needed now.
I think that, to come back to something you were saying before, there's this gray area around the TPI as to, well, this will be activated for a short period for liquidity reasons, and then we'll see. And then we'll see. We don't know what will happen when we'll see. And there, I think it's really critical now to make sure that central banks remain credible as players, not just pouring money anywhere at any time, because of the precedent we've created since 2008, in a sense. But then in that period, and that links to the second point, I think the ESM could be very useful in helping government fulfill some, meet incentives to behave when they form their budget, to look at expenditure when it's still time to do so, before the crisis comes in. And in that sense, I think a lot of thinking has to be done. It's not for the central bank to do that, but it is for an institution that has the credibility as some rule setter or standard setter, because it has the credibility
it has to be credible
money.
As a non-player. When will the ECB really not come in and I will take a loss? And I don't see anybody who's, that's a tough decision. Somebody's thinking about holding a large portfolio, debt finance portfolio of government debt, earning the nice spreads. You got to think to yourself, boy, oh boy, I might lose money on this. I better diversify that portfolio. A government has to say, oh boy, the ECB might not come in and hold down my spreads on the next rollover. I better do something about my budget. And I don't see that.
So
pre-commitment not to act is the only way you get people to put their affairs in order ahead of time.
I completely agree. And then it comes to the politics of the budget. I just take as an example what has happened in France over the past year and a half. There's an idiomatic, an expression that has become popular in widespread television, which is the word, the IMF in Paris, right? So people in the street now know what it means to have the IMF in Paris. It means that discussing about expenditure, discussing about having a stable budget is something that may, if it's not respected, may have concrete consequences on the daily lives of people. And I think this link has been missing for a very long time in many countries. And now that this awareness is around, we really need this commitment mechanism for governments to be able to take hard decisions that are not popular.
On that one, I agree in the sense that we need a clear commitment mechanism. I do think we have a reformed fiscal framework. I do think that maybe, at least in markets, the 3% deficit is something that people are oriented towards and that they take. And I also think that if you look overall, governments do not like to be in excessive deficit procedures. Maybe we can strengthen the incentives, and we should be strengthening the incentives, but there's another way of going about it and actually trying to handle that. And I think with the revised framework, we have taken some steps in that direction. I personally think also we should work towards having stronger positive incentives. For example, Next Generation EU, you had a lot of reforms. Now the European Commission is basically making the proposal to link EU budget means to national reform programs, which would be a positive incentive, which can also be with a view to tax policies, can be with a view to other policies, and certainly with a view to growth. So I do perfectly agree that there should be as strong a commitment as possible, whether that's then ESM in the European framework or someone else. Certainly when it comes to crisis, then it's also ESM having a role, and that is what is foreseen in the revised treaty. So still, when you are there, you need to have the right toolbox. And I personally must say, if I nowadays can say I feel safer in Europe, I also feel safer because I think the toolbox existing once you are there of central bank and crisis mechanism interaction, we have a more complete toolbox. Also on the side of the ECB. And on that one, I'm happy to have it as a safeguard because, at least from my perspective, the issue of just needing some time in a very rapidly evolving market is a serious issue.
Well, I think you're right here at the paradox of all crisis management, which is when the crisis comes, I'm going to bail out, you're going to bail out, we're going to flood it with money because once the crisis has come, that's the only way to stop it. But if people know we have that tool, they have no incentive to get their affairs in order, to keep some liquidity around to buy on the bottom because they know we're going to front run them by keeping market prices up, to hold non-concentrated portfolios. So it is only the pre-commitment to have weaker tools that allows the system to be less fragile in the beginning. And I don't think there's an easy way around that. If you have infinitely powerful tools, everybody knows you're going to use them. And so everybody stores gasoline in the basement. That too big a firehouse leads to gasoline stored in the basement.
In that sense, are current circumstances that new in the end? So this issue has always been there. And it has always been related to this solvency versus liquidity issue, which you cannot identify in real time when the crisis comes. Hence, the need for the best possible incentive mechanisms beforehand.
But there is a lot we can do. For example, not every increase in interest rate is fragmentation and dysfunction. It is good for governments to see high interest rates on their debt because that tells them, that gives them the market test. If you better get your finances in order, if some commission in Brussels says you need to get your finances in order, that's nice too. But the rubber hits the road when you can't borrow money at under 15%. There's a lot of interests who like the current fragile system. So, why are bank portfolios still so country specific? Why are banks not holding diversified portfolios of government debt? Why are they holding so much government debt at all? There's lots we can do to make the system more resilient ahead of time, short of threatening, we're going to let you burn down after the fact, which is a tough threat.
Which is not credible usually.
Which is not credible, and so nobody takes any.
No, again, there is the question. So the point that you raise is the fundamental point of time consistency, right? So what you can commit to upfront, and what you will do once you are there.
Exactly.
And so you make a strong upfront commitment. At the same time, you may know that once you are there, it's a very difficult call to actually not help. We see it all the time when there's flooding and the government is stepping in eventually.
But if I may, this is where the ESM was brilliant. I love the ESM because the euro was set up with a commitment, the ECB shall not buy government debt. And then a crisis came, so, oh, well, so much for that. The ESM was set up as we can use fiscal resources to give temporary help with conditionality. That is a system that is not pure, we have all the tools to put out any fire. It's well designed ahead of time to give a lot of good incentives. Let's use that more. You said Europe learned a lesson. I think Europe is in danger of forgetting that wonderful lesson.
And sorry, I might sound monetarist now, but it's not money creating, which is the big difference with what the central bank can do.
It's a fiscal transfer, not a monetary transfer. Gets the ECB back to inflation.
I mean, my perspective it is that Europe has learned the lesson to a large, in different respects. It has learned the lesson by trying to improve the system, and what you said about the banks holding government debt, we are not back to the levels that we saw. We see diversification in bank holdings, but it's true, it's a point to watch. And I also agree there is a point that future regulation may reflect upon and maybe change in order to make sure that we don't have an overburdening anymore. I mean, that's part of the discussion also of completing banking union and having regulation in that regard in place, and that will help to create a stronger backstop. Still, a lot has happened on that side. On us as a crisis resolution mechanism, we stick to our guns. I mean, we are there for helping when there is a crisis.
And hope they call on you more often.
And yeah, but the question is, I mean, this is like, I see ourselves as a fire brigade, as an insurance that you want to have. And it is exactly there for that purpose.
Yes,
which is, again, is a lesson that was drawn and something that was set up. Now the point is our toolbox appropriate for the risks that we are seeing at this stage?
You put your faith on regulation. So the euro's been around 25 years, and nobody can say out loud that sovereign debt is risky and that should be treated as risky in bank portfolios. That seems like a fairly simple regulation. I hope we don't have to wait another 25 years before we say sovereign debt's like corporate debt on a bank balance sheet.
That's a long-standing debate in the media. But in a sense, you pronounce the word insurance, and I think this insurance concept can be deepened in the precautionary dimension of what the ESM is doing. For now, we still have a lot of stigma associated with being, to some extent having to do with the ESM and what does it mean, and those credit lines, is it a signal of something bad coming? Is there information asymmetry? If we could get rid of that and maybe add new mechanisms to link, so that governments can hook themselves with the ESMs. But in a way that is
stigma good thing though.
Yes,
because we want governments to do something so they don't need ESM help.
Exactly, that's
so
exactly what I'm saying. What I'm saying is that if I could have a contract or something linking me to the ESM that would help me in my parliament saying, look, if I really manage to cut expenditure by X% this year, and mind you, over 3 years, then we are a bit safer on the market side, because if something wrong happens in market developments, then the ESM will be, without anyone noticing, like an insurance company, there to avoid that things go too wrong. So I think, in ex ante terms, I think that would be very useful.
One of the practical lessons I learned, there was a big fear of governments coming too fast to ESM to get quote-unquote cheap money has not happened. Has not, I mean, not happened before. The problem is rather governments waiting too long, and then crisis fighting becoming overly expensive. That is because problems increased, and then we had to rescue. The rescue had to be bigger. So from that perspective, it's certainly one of the lessons is that precautionary elements would help. Second point is on stigma. That's also our analysis, is that we should be working on stigma, and that is where we have made proposals, among others, by looking into the fact that you may have collective applications, if you wish, of several countries, and that brings us again back to where we are at this stage. Suppose that a group of countries threatened by a common geopolitical factor, then you can also imagine that they basically jointly ask for insurance, and that the insurance provision is, yes, if things really turn bad, we will help you, we will support you. And that would, for example, greatly help to undermine any kind of stigma. You have seen it a bit on the Commission side now when this question of do you want to have access to this safe instrument for financing defense, where a collective application can be of an advantage. So I think there are elements that we can move, which should not still makes us kind of just a provider of cheap money, but it sticks to us being a crisis mechanism,
yeah, I think
but helps with the stigma issue.
There's a big danger here of the ESM morphing from a provider of temporary fiscal help in a crisis in return for conditionality of you're going to do the difficult growth enhancing things that'll let you pay off your debt, to hey, here's some money to help you pay for defense. Here's some money to help you pay for X, Y, and Z. You don't want to go there.
No, we don't. We're not there. So we stick to the financial stability mandate, but financial stability risks, you may, I hope we can agree that once the financial stability risk kind of is realized, then you're in the crisis, then it may be more expensive. While if you can have kind of a precautionary shield that says if you get there, if a risk of a war or if a risk of an intervention comes up, then we are there to help you. That gives market confidence up front.
With the conditionality, or we're going to help you, and when does the conditionality get put in?
You can have two types of conditionality. You can have conditionality, and that is what we did with the pandemic support facility as ex ante conditionality. You have access to the tool if you are in a healthy economic state. Your budget is basically okay. So to make sure that if we provide support, it's not a solvency issue in the first place. That is also, the IMF has a tool in that regard as a precautionary line, and that is the spirit of it. And obviously you can have ex post conditionality. Again, when we think about the pandemic, the ex post conditionality was really use the money that you can have, which was limited in size, for the purpose. This was not about doing a pension reform when you're fighting the pandemic. This was using the money for the pandemic. If you have another direct source, if you have a major flooding that really where markets kind of, you have a major fiscal cost, the main point is kind of deal with the flooding, not do a pension reform, right? So there is a question of how you, and that is part of our framework, was always part of our framework, that conditionality must be adjusted to the circumstances needed. And if the circumstances are that there is a major macro financial fiscal disequilibrium, it should be addressed.
I think we're in great danger here, though. Financial crisis I think of as a liquidity, a run, something short term. The way governments meet a crisis by borrowing a lot of money with a credible plan for repayment, that's how government debt is supposed to be used. Government debt is a good and great thing. I think we've been bashing it too much. Government's ability to credibly say, look, I can raise taxes and cut spending in the future. I'm going to borrow a ton of money because there's a literal flood, there's a war, there's a pandemic. I borrow, everybody understands I'm going to be able to pay it back. There's no inflation. I don't need the ESM. I don't need the IMF. This is not a crisis. I'm just borrowing a lot of money for a temporary necessary expenditure. That's the way it's supposed to work. And I sort of hear you edging into, well, if there's a temporary thing we'll call a crisis, which is what normally governments just borrow for, we'll come give you the money. And that's not what a crisis is supposed to mean. That's not systemic. That's just normal government borrowing when it's healthy.
Well, I mean, that is when markets would be working perfectly, in my understanding, and would be willing to finance governments under those circumstances.
I think we overstate our ability to diagnose what markets are dysfunctional and fragmented versus what are just prices. I think there's a quick jump to markets are all terrible, as opposed to markets are telling you something that you ought to be listening to.
Well, what I have experienced and what is part of the reason why we have a fiscal framework, what is certainly part of the reason why we have a crisis mechanism, is that it's indeed very hard to predict market dynamics, and when they emerge can be very harsh. And that is
Harsh doesn't mean dysfunctional. Harsh means
I'm not saying
bad
about
realities.
No. I mean, but still at that moment very hard to cope with, and dysfunctional in the sense that they may then cut off a country of financing, of affordable financing, in a situation where you don't want that to happen because of the fears that they have, and you need then exactly the mechanism like an ESM in order to back it up and make sure that that functioning can be maintained. Again, against the appropriate conditionality that you want to have in order to bring the country back to the market. That is what we are there for. But that conditionality may look very different depending on the circumstances, which is still not saying that it's absolutely not saying that it's easy money.
The point of conditionality is that the markets had it right, that there's something fundamentally wrong with this country's promises of how it's going to pay back its debts. We need to fix that, and that will restore market access.
I'm not so confident that markets are so great in precisely judging that. Honestly,
the question is, are we any better? Markets are terrible. Markets are dumb. But are we sitting in a nice office any better at figuring things out?
Well, I think there's one dimension, though, that makes a difference between markets and is that there are, the universe, 𝗰𝗵𝗶𝗀𝗶𝘀, the universe of possible outcomes, is something we want to master. Take, for example, the euro risk, the risk of Eurozone breakout. We don't speak about it anymore. That's a big success of what has been done so far. And in a sense, what is being thought now is being thought of under the condition that this scenario is given a 0 probability and will be given a 0 probability forever. And this is those are the circumstances that we want to protect in a sense, because then there's an existential threat that gave rise to all the exotic things that we created since 2008, 12, etc. The asymmetry. The market will be willing to test the borders of the universe, and official institutions will be there to say, look, that's where we are, and we will never be outside of this.
This is a good and great thing, and I've been too grumpy. I want to say something really optimistic. What you just said, we have gotten away from leaving the euro and redenominating our risks, default through redenomination, which would be a terrible thing. I don't know if it's 0 probability, but that's way farther off the table than anybody thought. And that's a wonderful achievement.
That, I think, is a nice conclusion of our discussion, because one way for me understanding the ESM is also that we are eventually the safeguard of the integrity of the euro area. I think that is what actually we have achieved over the past 1.5 decades of existence, and that is core. That's core to the safety of the euro. Thanks a lot. It was a great discussion. Quite some controversy, quite a few things that we learned.
Yes.
Thank you.
Thank you very much. I didn't promise too much. We had a wonderful lunch talk with my guests, John Cochrane and Natacha Valla, where we discussed a number of issues. We discussed new sources of crisis and found out that liquidity issues may be more important, but also that many of the crisis drivers of the past are still in place. Most importantly is also that governments need to keep healthy budgets. We talked about stablecoins and how they may shape the future, and what are the tools that we need for crisis fighting. And we agreed that a lot of tools have been brought forward in the European crisis. We had some divergence, though, to see exactly how they helped and how good they were. Those differences remained for discussion. I think we concurred in the end that there are a couple of important points. Governments need to have firm commitment devices, and that actually the ESM has been helpful in safeguarding the integrity of the euro area. We have a number of tools, and those tools should then also stay related to preserving financial stability and creating the right incentives for governments. That, I think, is a common conclusion. So overall, a rather diverse discussion that covered a lot of areas, but also some good conclusions in what I said at the start. I think the euro is safer today than it was in the past. See you at the next ESM lunch talk.